Now, the Italian finance minister Giovanni Tria will have to sell his country's budget proposal to his European counterparts this week. Tria is likely to face questions about the populist government's plan to set a 2.4% deficit target. Markets have been spooked by the announcement. Now, Italian bonds dropped for a third day as investors remain concerned over potential friction with the EU. Now, John Normand of JPMorgan and Janet Henry of HSBC are still with us. Janet, do you worry about Italy dragging down European growth?
Not growth per se, but I think what's happening in Italy is a reflection of the ongoing challenges that the European institutions face in terms of getting all member states on board with the rules effectively. And I think that the challenge with Italy isn't so much just the headline budget deficit that they're projecting for 2019, being certainly bigger than markets have been led to believe, and the finance minister himself had indicated. It's that they've said that the deficit is going to be of the order of 2.4% of GDP for the next 3 years. Now, that short term, that might actually add to growth, but it's the longer term challenges associated with that and how they negotiate with the European institutions that I think will be where the big challenges come from.
Did the markets overreact, John? At the same time, 2.4 is not 3%, and they have to kind of deliver on the promises that they put in the campaign.
Well,
to some extent.
It depends on whether you're an Italian voter or a market participant. 2.4 is no big deal if you're a moderately indebted country. 2.4 with no end in sight to the debt to GDP ratio is a problem from a market perspective. So I don't think what you saw in the bond market was an overreaction at all. It's simply reflecting the fact that Italy is going to have some enormous challenges over the next year if debt to GDP is not on a downward path in the context of 2019, where the Fed is raising rates and the ECB is raising rates, and there's no QE from the ECB either. So I think the reaction is completely reasonable.
Okay, are we going to have... Sorry, Tom, go ahead.
No, please, Francine, go ahead, I insist.
John, sorry, I overstepped, Tom, because I just had to get this question out. Do you think it's going to get worse? I mean, could the markets... The more the markets are in turmoil, the more it will test the resolve of politicians.
I think so, because there have been several opportunities over the past 3 months for the government to deliver something which would have granted some of the election promises or campaign promises, but also respected some of the debt sustainability obligations within a currency union. The fact that they did not do that shows that they have a different set of priorities, and I think it will require more market stress to rebalance the priorities a bit more towards debt sustainability and therefore bring down spreads.
Do you see any indication, John Norman, of what the stress will play out for Germany, for the Netherlands, for the core of Europe? I'm fascinated by how serious everyone's taking Italy, but it's a mystery how Germany and others will respond to whatever the crisis may be. How will they respond?
Well, I think it's usually just on the rhetorical level, meaning they'll highlight what the rules around fiscal policy are in a currency union. They'll reject the budget if it doesn't show debt to GDP declining on a multi-year basis, and they'll hope that the Italian government will come back with a slightly lower deficit target for the next couple of years. But that's really the extent of what they can do. There's no way to really enforce fiscal discipline on another country within Europe from a governmental level. It only can be done from a market level.
And Janet, what's so direct here is Italy is not Greece. I mean, that's the heart of the matter. And how will these core countries treat Italy if it's not Greece?
I think these core countries that you mentioned are, certainly for now, going to allow the European institutions to take the lead because, you know, a country like Italy has to submit its budget to the European Commission. They have to take a view on whether it's realistic, and that's certainly what we're waiting for over the next couple of days. It's what is the growth assumption? Because obviously what Italy is going to argue is that growth is going to be sufficiently strong, and that's going to support, mean that the debt to GDP ratio still trends lower. They may also come up with some numbers regarding the tax amnesty. So if they can paint a convincing picture regarding the growth and the tax amnesty and other potential measures to make, their numbers still point to a reduction in the debt to GDP ratio, there could be some scope for compromise. But I think the initial round of where we go from here was that it will be led by the European institutions rather than individual leaders of individual countries.
Janet, let me bring you over to my chart. This is a simple chart looking at the spread between Italian and German 10-year yields. Again, does that put pressure on euro, and does that actually make the European case for more bullishness? Because a lower euro helps with exports.
Yep, a lower euro does help with exports, but as with all countries, most countries are much more dependent on external demand than they are with the euro. So actually what we've seen this year is that even though the euro for some this year was weakening against the US dollar for quite a lot of it, world trade growth was slowing. So Europe still had slower export growth. And certainly we think from here that the dollar is likely to resume rallying and is going to be strengthening as long as the Fed is expected to continue tightening policy. So, if we see a slightly weaker euro, it will help at the margin. But for exports, it's more about world trade growth.
Where do you see this going? Do you assume, John, that actually the spread just keeps on widening until we have a budget deficit of 1.8?
I think so. Meaning we've seen the government become a little more reasonable when the spreads touch 300. It's a very young government, so we can't say that this is proof positive that when we reach those levels, the rhetoric will turn more conciliatory. But this is how I think the situation will play out. It's similar to situations we've seen in other countries like Greece. Spreads widen. The government becomes a bit less aggressive in terms of its fiscal demands, and then the market stabilizes again.